So that question, along with the path of interest rates, is probably top on every investor's minds. Our investment process, though, we don't spend our time making macroeconomic forecasts, those big forecasts about the world. What we spend our time doing is looking at individual companies. And so people are worried about a potential recession. So we want to see, does the valuation discount a tougher time? And secondly, is the balance sheet, the financing of the business, able to cope with tougher times? And that's the two areas we spend our time on to give us comfort about dealing with a difficult period like a recession.
I think the key question there is in terms of timing. When we say this year, we're not sure whether or not the global economy would tip into a recession this year, but looking out over the next 12 months, we think that there are a lot more headwinds than there are tailwinds. The different parts of the world are behaving in different ways, but when you look at the US, the UK, and Europe in particular, we see slowing economic growth, and we see a lot more headwinds to growth than tailwinds. You just look at high inflation, rising interest rates. All these things are problematical to growth. And whether or not, again, we technically go into recession or not remains to be seen, but we definitely are seeing with our companies that there's a slowing of demand and that the economies are growing below potential at the very least.
The link between stock market performance and economic health. In the short run, stock markets do tend to follow the earnings of businesses. So if earnings fall in recessions, stock markets are likely to do poorly. But it's very important what the starting valuation is. So for example, if the stock market is already very worried about something, it may be the case that stock markets don't fall too much. Conversely, if stock markets are taken completely by surprise, as they were just before the great financial crisis, then things do fall quite sharply. Earnings are important to stock market performance in the short run, but the same thing is true is that the starting valuation is also very important.
Well, the answer to that question really depends on your time horizon. Over the long term, there's a very strong link between economic health and stock price performance. If the economy is doing well, companies tend to do better, their profits tend to grow, and stock prices tend to rise. Over the long term, stock prices tend to follow earnings growth. However, over the short run, you can have a floundering economy and stocks can do quite well as interest rates begin to decline. Typically, when the economy begins to get weaker, eventually interest rates tend to go down, and that can help stock prices quite a bit. So it really depends on your time horizon. And so in the short run, I know this is a little bit confusing, there's really not much of a link between economic performance and stock prices, but in the long run, there's a strong link.
It is likely that stock markets may well fall if the economy deteriorates. That's because stock markets tend to follow short-term earnings, and earnings fall in deteriorating economies or recessions. However, it's never that straightforward in stock markets. For example, if the valuation of markets is already discounting a tough time, it may well be the case that in aggregate the stock market doesn't fall that much. And so it is a combination of falling earnings, but what the starting position of the stock market is just as important.
Yeah, there's a real tug of war in that question. There are really two things going on. On the one hand, a tougher economy, and the economy is getting tougher in our opinion, all else being equal, would put pressure on stock prices. Earnings growth would slow, perhaps turn negative, and as that happens, that would be a negative factor for stock prices. On the other hand, if we can see the light at the end of the tunnel and see an environment where interest rates might start to decline, inflation starts to decline, that portends much better times ahead. And so the answer to the question is a matter of timing. There certainly could be a dip in stock prices, but that will probably be followed by a sharp rebound later. We think it's important to focus on fundamentals, the fundamentals of the businesses, and take advantage of stock price volatility and not try to micromanage the portfolio based upon macroeconomic factors.
So the portfolio tends to be reasonably balanced between companies that are a bit more cyclical and some are a bit more defensive. But we don't tend to really look at it at the starting point like that. What we look at is, what is the valuation of the company? How cyclical or defensive is it? And if the earnings are to fall, does the valuation already discount that to a degree? And so we're always trying to marry up the starting valuation of any investment versus the behavior of that business during tougher times or better times. And we don't tend to have a blanket, is it defensive or is it cyclical approach?
Well, the answer to that question depends on whether we're talking about stock price performance or the underlying fundamentals of the business we own. Our companies have very strong balance sheets, they produce a lot of free cash flow, and they are competitively entrenched. They tend to get stronger when times are tougher and rebound when times get better. We're very pleased in a challenging economic environment with how our companies are performing, and our values are therefore stable. If values are stable and stock prices decline, which they could if you get into a recessionary environment, at least in the initial stages, that creates opportunity. We can buy more of these great businesses with stable values at lower prices, which means we own them with a larger margin of safety.